afternoon, ladies and gentlemen. A very warm welcome to you on our special show, Market Guru, where you meet the finest professionals on Dalal Street, people who have navigated bull and bear markets, markets that have been enthusiastic, markets that have been in bubble, and markets that have seen bad days. We are delighted to welcome Mr. Rishi Kohli, Chief Investment Officer at Jio BlackRock Asset Management Company, the newest kid on the block as far as the booming mutual fund business is concerned. Mr. Kohli has been in the markets over the last 25 years. He's worked variously with Incred Capital, Avendus Markets, SSKI, ICICI, and for about 13 years he ran hedge funds for US clients based out of Mumbai. A very warm welcome to you, Mr. Kohli. It's indeed a pleasure to welcome you at a time when markets are really going through a very bad phase. How do you analyze sentiment on the Dalal Street at the moment?
Thanks for having me on the show. It's great to be here and speaking to you. So on the markets, yes, I think markets have been difficult over the last year, declining initially by headline indices, declined by more than 15%. And then recovering, and then in the last few months obviously been more range bound with a lot of volatility and dispersion of performance across sectors and stocks. I think that is the phase which is sort of continuing right now. So we did see a few weeks back markets trying to bounce. Over the last few days it's been coming down. I view it more as a consolidation phase in the very long-term bull market that India is seeing. You saw 2-3 very smooth uptrends, smooth years of uptrends in the markets, and valuations got overextended from a price-based perspective. You were overstretched, so all of that had to lighten down a little bit, which is why this consolidation over the last year I think is a good step in that direction. I expect a couple of quarters more of this volatility or uncertainty, and post that, things should slowly start looking up again.
Okay. Mr. Kohli, as far as the government is concerned, it has done everything that was possible at the decision-making end. You've had GST rate cuts in September. Before that, a fabulous monsoon across the country. Interest rates have been cut by 100 basis points. And in February, we also had the rejig on income tax percentages. All this put together is quite a positive cocktail as far as fund managers such as you are concerned. Do you think this is enough that the government has done, or is the market expecting a lot more?
So no, you're right. I think government has done whatever it can. I mean, obviously market would expect that there be more rate cuts and more measures that are taken on the fiscal side, but obviously all of that math needs to add up. So I think from that perspective, largely all been good features, but still markets have obviously been sluggish, and that's obviously to do with the global uncertainty as well, right? All the geopolitics and all the tariff related stuff that is happening is not made it easy for Indian markets in particular. And that is why you've seen Indian markets being sluggish and also sort of underperforming the other EM markets. But do remember that, for a few years, the other EM markets were not doing much, at least the larger ones, and India was doing really well. So that, those phases will keep coming and going. So from a very long-term perspective, that is all fine. But yeah, from an immediate perspective, I think a lot of the things around the tariffs and the global geopolitics, all of that is still not settled. And you also have, President Trump, coming out and changing views on certain things or coming up with new ideas. So again, that leads to a lot of uncertainty as well. And markets, obviously, as we know, don't like uncertainty. So more than specific reasons, the fact that there's uncertainty out there will keep a lid on the markets as such. But again, it relates to the couple of quarters I mentioned, because, hopefully a lot of things die down by then or settle down by then.
Right. Okay. Mr. Kohli, let's dig a little deeper. For the moment, Jio BlackRock has about 8 funds. This is the first quarter of operation. So there's a liquid fund, there's an overnight fund, and of course you have a money market fund, 3 or 4 index related ETFs, which is Nifty Next 50, Nifty, the mid cap index as well. Now, what is the game plan as far as Jio BlackRock is concerned? You have the largest Indian corporate as your partner, plus a fabulous reach via the telecom network of Jio. How is the business plan structured in India?
Yes, sure. So far, we've launched these 8 funds, as you mentioned, and these have largely been simple fixed income funds or passive funds. Currently, the NFO of our Flexi Cap fund is going on, which is our first active fund. There are plans to continue launching, more funds on each of these categories. So we would do more passive funds over time. We would do more
Okay.
active funds over time. And active for us is systematic. So these will be systematic, active, process driven, data driven, rule driven funds. All of these, and then there will be fixed income funds as well, right? So all of these were in parallel C launches over the next few years. So that is on the product side. On the clientele and reach side, of course, as you correctly mentioned, because we have internally the JFS app and the MyGeo app, so those collectively have connectivity to a very high percentage of India's population, and therefore they become good tools for the digital outreach that we believe in and want to have a strong participation from, not only now in the near term but also in the long run. And that feeds into a key goal the JV joint venture has, which is to increase the financial awareness, financial literacy across India, and also start seeing that financial inclusion
Right.
kind of social impact across India. So we feel that digital channels will help us reach the length and breadth of the country. And the only thing is that there needs to be more, awareness and literacy that builds up. So there needs to be a continuous market education that needs to be done. And which is why even for this first active fund, you would have seen that we are coming out with a lot of podcasts and interviews and articles and other things, because that is how we can, in a very simple manner, start explaining to retail how some of these things can help them in the long run. And then we have other digital partners, right? So it is not only the Jio apps, but also, all other digital partners, a lot of fintechs which let their retail investors invest in direct schemes. So all of those are also partnering with us and are a key part of the strategy.
Okay. Mr. Kohli, you have an unusual background in the sense that you've done a lot of quant work at Avendus. You launched their quant business for India. Before that, for 13 years, you've run hedge funds for 2 US based organizations. At this stage of Indian mutual fund history, how do you see quant based algorithms changing the game plan as far as our markets are concerned, in terms of investments, in terms of attracting investors, most of them from the Gen Z space, and more importantly, we've traditionally seen Indian mutual funds believe in buy and hold and make money over the longer term. Do you think there is a disruption ahead as far as the fund management and investment thesis in India is concerned?
Okay. So firstly, the first part of your question, so, drilling a bit deeper into that. So the reason why, this JV has happened and now we are starting with these systematic active funds, as we call it, because BlackRock globally has this division which is called SAE, which is Systematic Active Equity, and that has about $300 billion under management. And the approach they follow, has had good impact across the world, not only in US and other developed markets, but also in emerging markets and especially single countries like China and Japan. China is also a similar market to India, in the sense that some of the traditional data and traditional metrics are important, but also a lot of alternative data and new age metrics are important. So that approach has helped there as well, and which is why we are bringing it now to India, because we do feel that it can have a large impact over time, and that is currently missing in India. But this was the broad thought process. In terms of the market dynamics, why India is ready for such an approach, we feel, is that for a systematic approach, you need a good length and breadth and depth of stocks. You need better sector representation. You need a lot of data, and you need a lot of clean data. So, and all these things have happened in India over the last 10 to 15 years. So if you went back 15 years and thought about a lot of these things, your breadth and depth of stocks, sector participation, all this was very poor. The liquidity across even the top 500 stocks was very poor. A lot of data was not there or not clean enough to be able to use in a systematic process. All of this has actually improved drastically over the last 10, 12 years especially. And that is why it lends itself very well to a systematic approach. And that is the key reason for us to bring this systematic active equity approach to India at this point in time. Right? So that is around your first part of the question. Second part around whether the market is ready and how it can disrupt, etc., is more to do with the fact that you do have large part of the population which is young and which is very digitally savvy, and you are seeing a lot of direct flows and flows through SIPs, coming in through all these digital platforms. And therefore, again, a systematic approach being more data driven and technology enabled lends itself very well to that, digital participation and the younger crowd, which, has an appreciation for more data driven, rule driven and systematic things. So whether, even if a lot of these retail investors are not sophisticated, we do believe that their understanding and appreciation of some of the data and technology will make them receive some of the financial awareness that we spread very much faster than what all of us are thinking. And therefore, it will help us in the long run. But honestly, there is so much of penetration to do in India that I think it is not about disrupting that. I mean, we are trying to enable that. And therefore, I think the mutual fund industry has a long way to go. There'll be 2-3x the growth over the next many years, and everyone would benefit out of that.
Right. Mr. Kohli, because of your background in quant strategies and now as a CIO, do you feel that hedging as well as many other such techniques will be the core of Jio BlackRock's differentiation strategy over other AMCs?
So see, on the active side, like I said, it's active equity side is going to be systematic active equity, this approach which we are bringing from BlackRock globally. That is obviously very different from the rest of the market in two broad things. One is that the process, the portfolio generation process itself takes, not only the alpha scores, what we call, which are relative return expectations of all the stocks, into account, but also takes the risk scores and the transaction cost modeling and liquidity scores of each of the stocks into account. So our return expectations or alpha scores, the risk scores, and the transaction cost model and liquidity understanding models, they all go into what we call an Aladdin optimization engine, and that throws out the portfolio. So our portfolio generation is already accounting for risks and costs. Otherwise, mostly we are used to thinking about risk and cost after the portfolio is generated in India, right? So it is a very different approach and therefore highly differentiated. The use of alternative data is there. So, we have traditional data, which is all the fundamental data, a lot of flow and price-based things, but a lot more on the traditional data, but also a lot of weightage on alternative data, which is again very different. And obviously BlackRock has a lot of data globally on Indian stocks also on the alternative side, which we are able to leverage in this strategy and in all future products that we launch. So that is again a very big differentiator. And to put it all together and sum it in one sentence, it is more about bringing very consistent alpha generation with lower risk to the market, which again is not the way we are typically used to thinking about participating in the equity markets in India, because typically, we look at approaches which can do very strongly in the short run, but that also means that any long equity approach, goes through a tough patch. And when that goes through a tough patch, you end up seeing a lot of underperformance on the downside as well. We want to keep that journey much smoother, right? We want to not deviate too much on the downside when it underperforms, keep that active risk on the downside or the underperformance of alpha to a very low number, and keep that volatility also lower, so that the investors can remain invested for the long run. The more volatility you give them on the underperformance side, there is a higher probability that investors would exit at the wrong time. So that possibility, probability is what we are trying to reduce as much as possible, while not giving up on the attractive alpha over the long run. And BlackRock SAE approach has shown that it is possible to do this in the long run, even in markets like India. And therefore, that is a new theme we are bringing to the market.
Right. Mr. Kohli, is there a ballpark AUM that you have in mind that after the second year of operation, Jio BlackRock AMC should have at least so many lakh crore or 1,000 crores under its AUM? What is the growth path at your end?
No, not yet. So as of now, we haven't really targeted or narrowed down on those numbers. And of course, over time we will, but it all depends on, how some of these systematic active fund launches go. What is our experience in terms of how much participation we are getting from the retail, from digital channels, whether our own or our digital partners, how the larger investors are responding in terms of our direct sales team, and the RIAs, the advisory firms, which become our partners as well for the larger clients. So there's a lot of experiments and a lot of things we are trying to do on the sales and marketing and communication side for both retail as well as larger clients. And it really depends, because in the passive funds and the simple fixed income cash funds, you don't really get those insights or that kind of widespread participation. But in some of these active funds, you do, and therefore there is more scope to understand how the different channels are behaving and how they can impact us in the longer run. As we get more clarity from the current FlexiCap fund launch and a few more active funds down the line, then I think we'll have much more clarity to be able to, narrow down on some numbers over the next few years.
Okay, fair point. Let's get back to the market and analyze what Mr. Trump has done last evening, as also telescopically over the last 6 months or so. IT is absolutely down in the dumps. Stocks like TCS, Infosys, cash rich, blue chips, debt free are now forced to languish at 3-year lows. For a possibly a quant strategist, how do you see both the IT and the pharma space at this point of time?
See, for our approach, what happens is that we are participating in all the sectors. So for this fund, for example, the benchmark is NSE 500, and whatever sectors are there in the NSE 500, we would be there in all the sectors. But what our process does is it has some bounds, what we call, which think of it as weightage constraints. So we'll say, let's say IT, for example, we will not deviate from plus minus 3% compared to the IT sector weightage in the benchmark, right? So whatever weightage it has in the benchmark, if the model says that it wants to, underweight, then it will go to maximum minus 3% from whatever benchmark weightages are there for that sector. And if it wants to go overweight, it will go to a max of plus 3%. So there's a narrow room to move. Within that, obviously, active calls are taken because we have a weekly rebalancing approach. So on a weekly basis, all the different traditional and alternative data signals that we have, there's some weighted average of that goes into the process. And because we have alternative data, which is, getting updated on a real time or on a daily basis, so there is scope for some of that, or, some of this news and sentiment data to impact the weightages or the portfolio composition. But at the same time, obviously, the larger weightage is on the traditional signals, which are more, quarterly, and some of it monthly, but largely quarterly. So therefore, the weightage changes happen on a slow basis. But yes, on a weekly basis, there is an updation of the analysis. So any recent developments that have happened, or any of the alternative data or news sentiment, we have the LLM models which are very strong. Any of that changes anything, then those changes get updated. But what we call is we are benchmark aware. So we will not like deviate too much from it. But within that, we will focus on stock specific opportunities. So if there are certain stocks, which are less impacted, they would get weighted more compared to the ones which are impacted higher, but again within certain bounds. So it's a very benchmark aware strategy that helps us keep the risks low compared to the benchmark in terms of underperformance. But because the focus on stock specific alpha is there, we still, manage to get the alpha that we want in the long run.
My last question to you, Mr. Kohli, on the market part, and then we'll again get into strategy. Do you think GST cuts and other changes that the government has brought in to make consumption a little more effective in our economy will push Nifty to a fresh high in 2025 or calendar 25-26?
So I think largely some of the measures, especially the GST, obviously have been good and timely because it has offset some of the tariff-related impact we would have seen on the deficit and other things otherwise. But at the same time, I mean, it's not enough to really change the whole earnings growth cycle on an immediate basis. Obviously, it will flow through and take a couple of quarters, as I mentioned earlier. So for the next 1 or 2 quarters, I would still expect a more range-bound behavior even when the market is recovering. And then post March 26 for the next 1 or 2 years is when I would, see the upward momentum really building up from all quantitative angle, macro angle, as well as the earnings growth starting to pick up, post that. That is the indication that I'm getting. So for not the immediate term, but yeah, after March 26 for the 6 to 12 months after that, I think you should be seeing those kind of numbers, but not this year.
Okay. On that very, how should I say, somber note, let's look at some other parts of the market. Mr. Kohli, how about 10-year bond yields as far as India is concerned? Are we headed lower as far as long-term borrowing costs are concerned? Because you, at the moment, are a big player in the money market, overnight bonds, and of course, the liquid fund, the 10-year bond yield is central to you.
Yes. So, I mean, there I think there are expectations of more rate cuts both locally and globally over the next, 6 to 9 months. Broadly for us and the team, it also looks like some rate cuts would happen, but we are not as bullish on that. If market is expecting 2 rate cuts, our expectation is that there would be one. If the pace market expects it to be faster, we expect it to be slightly slower. So it is a bit of a mixed bag for us. But yes, I mean, rates should be similar to current levels or slightly lower in the near term. But how it plays out in the long term is really the key, because there, as we are seeing, there's tightness in the markets on the fixed income side, then immediately you see the yield spiking up. So some of that activity has been happening recently, which has not made it easy on that front also.
One thing I must say about fund management after Mr. Trump has assumed the presidentship at the US, that life is a bigger challenge and a more volatile day greets you on a regular basis rather than what, the normal tempo that we were accustomed to over the last decade, 15 years or so. Do you feel it's a challenging event to come to the office every day with him tweeting? No one knew what he would tweet the previous night.
Yes, absolutely. So I think that uncertainty is definitely there, and every day is a new day from that angle. May not be related to anything that even he has said or done in the last few days. He's liable to change some of that as well, depending on his mood. So that uncertainty is there, but that is where, uh, as you correctly said, I've been doing systematic and quant stuff for a very long time in India, especially. BlackRock has obviously been doing it globally. So one thing there that, has always helped me in the last 10, 15 years is, and helping me even now when all this Trump uncertainty is there, is that, we don't have to look at the news and worry about that all the time and then keep updating or discussing or changing our portfolio or weights or whatever. So I think systematic approach, that is the power of it. So to summarize, since you brought this up, I think that is a great example because, a systematic approach helps to tide all these issues and still stick to an approach which we know can still work in the long run despite all these short-term issues. So that is the beauty. And then, of course, I can be talking to you and not worry about the markets because there's a systematic approach and a data-driven approach behind which is running efficiently all the time.
So my final question to you is, are the days of hiring and keeping experienced fund managers over in the mutual fund industry? Will quants, algorithms take over this job of investing, trading, and curating portfolios? I'm sure you have a view on this because you come from the same background. How do you see fund management over the next 10 years or so in these days of automation and AI?
Sure. No, so broadly, my view is that both will coexist. So obviously, when we talk of active funds, for us, it's going to be mainly systematic active, or quant, however you want to call it. But I think there is an equally good scope for other traditional active funds also in the market over the next 10 years, given the growth that we're expecting. So I believe both would coexist. But yes, given that, we are new to the market, we would also expand the market and get more products out. And I think there are other players also who have some systematic and quantitative background who also want to expand the mutual fund market. So I think there will be obviously more participation from data-driven and systematic and AI-based funds and fund managers over the next 10 years. So that segment and weightages will grow. But having said that, it's not that, it will completely take over from the traditional side. I think there is enough room to grow for both the sides.
Let's hope that human intervention is the one that creates the maximum alpha. Thank you so much, Mr. Kohli, for this wonderful conversation. We wish you the best, and we hope that the AUM growth, the number of funds, and of course the returns that come in exceed even your wildest expectations. Have a nice time in India.
Thanks. Great being on the show, and thanks for all your wishes. Bye.
That, ladies and gentlemen, was Mr. Rishi Kohli, Chief Investment Officer at Jio BlackRock AMC, speaking to Business Today Television. Thank you for watching. There's a lot that's happening in the markets as far as bears are concerned. So keep on watching BTTV on the other side of this break. Thank you.
Hello and a very warm welcome to Business Today TV. I am Chetan Vatani. Well, Maruti Suzuki has been reporting a stellar set of numbers post the GST